Yeah, happy to be here. It's nice to be back.
We'll get some people, the younger people are
Yeah,
downstairs with their kids.
sure. And this is not the last time, you know. We'll be back. We can do this again if people would like it. Sure, it's okay.
With my apologies, the print is small, so if you want to see the print, you might want to come forward a bench or two. Yes, distance is not your friend as you get older when it comes to eyesight. Good morning and welcome. Nice to have you here. We understand there are competing items that sort of, take energy and ice cream. It's hard to compete with ice cream. It's absolutely hard to compete with ice cream. It's
Maybe
also
next
hard to
time we
compete
can-
with donuts right now.
We can bring some ice cream.
But thank you for being here. My name is Dennis Lefevre. I am an Everence financial counselor, and was just doing the math in my head earlier today. I've been on the Everence team now in my 26th year. How's that possible? But it is. Happy to have Jose Chiquito with me. Jose is one of our newer advisors living now here in Denver. You want to say a little bit about?
Sure. Well, I'm 25 years old.
All right. So I started before you were born. There we go. That's perspective.
So yeah, I'm new to Denver, and I've been at Everence for about a year and a half. I grew up in Goshen, Indiana. I'm a financial consultant, just like Dennis, and so well, actually, he's a financial planner, so more experience and a step higher than I am. So, but I'm a financial consultant, and yeah, just here to meet you all and talk about some good finance stuff. We do have a new office located near Coors Field. So we are on the corner of Blake and Park Avenue, if that gives you an idea. We're in a co-working space, so we have our own little individual office on the second level, and the first level is all like really cool and hip co-working space with young professionals. So, yeah.
Everence has an amazing amount of business in 4 communities where we didn't have offices previously. Denver was one of those. The other 3 are Seattle, Portland, and Phoenix. And over the next number of years, our plan is to plant offices in those locations to help support the business that's already there. So Jose's on the front edge of that. So you'll hear more about that new office location as time goes on. But we're here today to talk about the top 10 tips that young adults might want to pay attention to. And we are very open to starting wherever on this list you want to start. So with my apologies for the small print, and we also have a little extra art that came along with the whiteboard, compliments of a previous user who apparently used a permanent marker rather than an erasable marker. So you get a little extra frill around here. Feel free to shout out where you'd like to start, and we'll just talk a little bit about each. Let me run through the list so you can see them or in addition to what's there. Number 1 is know where the dollars go, know where the money goes. 2 is shop for the right number. 3, know your education savings. 4, give yourself a retirement raise. 5, teach them to make the right financial decisions. 6, understand home and auto insurance. 7, what's your family's mission? 8, don't worry about the Joneses, or as Jose said, or as I was writing it down, he said we should update that.
To don't worry about keeping up with the Kardashians.
Number 9 is help. 10 is reevaluate everything often. So I don't think we'll have time to cover all of them, but if you find one there that sounds really exciting that you'd like to talk about, shout it out and we'll dive into it. Or if you say nothing on that list is interesting and I have another question, we're okay with that too. Time is yours. Shop for the right number. Excellent question. So there's an old sort of saying in the life insurance world that you need to have X number or X times your salary or your net worth in life insurance. So the right number becomes what's the right level of life insurance coverage for your situation. And while there are industry standards out there, it really does become very specific to your situation. So for those of us who happen to be employed by a company that offers life insurance as a part of the financial package, you have some coverage through your employment. That's valid. It's worthwhile. It's workable. So your number may be different because your employer puts something into that mix also. In general terms, somewhere between 8 to 10 times your salary is the amount of life insurance coverage that is ideal for you. Now, again, it's a different number for each of us, and if you say, well, I'm not so worried about leaving lots of money to my family, then it can be a lower percentage, lower number because of that. Does that help? Sure. Yes.
Since you're talking about life insurance,
Yes.
can you demystify term and whole?
Yes.
Whole is one that gets pushed, but I understand it's less important than the term.
Yes.
What's your
Ooh,
advice on term and whole?
I'd like to take a
Yeah, go for it.
stab at that. So a good analogy for that is like renting and owning a home. And with term, you pay for it, and if it's kind of like use it or lose it kind of thing, and you kind of don't want to use it, right? Because that means someone dies. So with whole life, it's kind of like a retirement plan almost, where you're putting away money, and if you don't use it by a certain point, then you get to keep that money and use it. Dennis could probably make that clearer, but that's been helpful for me to understand.
Yeah, so with whole life, you're paying a little bit more because you're building equity. So it's like owning a home where when we make our mortgage payment, we're paying the interest, but we're also paying down the principal. Same with whole life insurance. You are building equity in that policy, which then means you have a cash value, which then means that you have options and choices that can be used for something else down the road. With term, Jose's correct, it's like renting. You have the coverage as long as you make the premium payment. But at the end of that term, the life insurance company says, thank you very much, we're done. So that goes away at that point. And you can re-up, you can redo, you can stretch it out, but effectively that's the difference between the two. Does that help?
Yeah, but whole ends up being more higher premiums.
Yes. Yeah, whole life insurance will be more expensive because you're getting more of a benefit down the road. And you have more options and choices. So that cash value that you're building could be used to borrow against, could be cashed out. You could stop paying premiums for a while because the cash value could pay the premium for you. With term, you're just making the minimum payment to stay in the deal.
It can be, I think it can be a case of, it's not a case of either or. I mean, if you have no money and your premium for whole life is $500 a month, and you need $500,000, you're not going to be able to do that. But so a combination of the two, or it doesn't have to be either or.
Right.
So maybe even a combination of both for some people.
Yeah, excellent point. So in my case, I have a combination of whole life and term. And one of my term policies has now expired. My kids are through college. I no longer need that much coverage. So I got to the end of the 20-year term and said, Auf Wiedersehen, don't need that one anymore, but still have 2 other term policies plus my whole life policy. And the idea with the whole life, for me at least, is that I want it to be alive when I eventually die, because I want to have something for my family when I pass. And whole life is excellent for that. Term is better to cover short-term things that we know go away. So kids' college, home mortgages, other sort of expenses in life that we expect to go away over time. Great question.
So probably, like, if we have it through work, just to clarify, if we have life insurance through work, that's probably term, is that right? I
Correct,
just wanted to
yeah.
clarify. Okay,
Almost always going to be term coverage through work, yes.
thanks.
Yep.
Could I ask about so the 8 to 10 times your income number?
Uh-huh.
Could you explain that?
Sure.
Why so much?
Sure. So the reason why that number is high is because it's a general number. So think about it this way. At age 25, I have a longer period of time with which to live, and therefore more expenses that I'll have to pay for. At age 50, I have a shorter period of time. I probably don't need 8 to 10 times at age 50, but I probably need 8 to 10 times at age 25.
What about age 40?
Okay. Yeah. We could do the math on that. So yes, to the, as we get older, in theory, we've saved more for retirement. We've paid down our home. We've gotten our kids through school. So the amount of life expenses that we would anticipate still having is lower. So as we age, that 8 to 10 comes down. Now, if that 8 to 10 seems daunting, it's better to start somewhere with something than having nothing. And that's why, it sort of depends on where you're at and how you view life and what you think those expenses might be and what expenditures you want to handle. So some families have said, my parents didn't pay for my college, I'm not paying for my kids' college. Well, then that 8 to 10 number is a lower number because those expenses are not as great. So it does depend a lot. And it's worth a conversation, and we're open for those sort of follow-up conversations with you about these things. And on the Everence website, we have some calculators that can be helpful for these sorts of things too.
And depending on your situation, some people use insurance for a very specific reason, like, they want to cover a very specific cost. Like for my example, I have life insurance because I own a home back in Indiana where my family lives, and I'm like, well, I'm very young, probably won't die, but in the weird case that I might, I'm like, it'd be nice to pay off the mortgage for my family. And so that's why I have it. And so, it's a very specific reason. So I don't need over $1 million in life insurance, and term life insurance is still very cheap. So it's kind of like a no-brainer for me because, helps me do something nice in the event that something weird happens to me on a hike or I get hit by the bus. So, but yeah, Dennis is right. We can always sit down and talk about your specific situation. Any other questions?
Can we just go over 5 and 7?
5 and 7. 5 is teach them to make the right financial decision. And then 7 is what's your family's mission. So let's start with 5. Teach them to make the right financial decisions. We're referring there to kids. And it relates to number 7 because the family mission can sort of intertwine with teaching your kids the right financial decisions. There's lots of different ways to teach kids about money. There's some that are better than others. I wouldn't say that any of them are wrong, but some are better than others. In my own case, what we did with our kids was when we gave them an allowance, we said you can put it in 3 different places. you can share it, you can spend it, you can save it. And I didn't define for them what the percentages needed to be. And so what I offered to them was, you want to go have a conversation? What I offered to them was the freedom to make their own choices. So, frequently what you would sort of expect is that 10% sharing, maybe 10% savings, maybe 80% spending. What they picked on their own was a third, a third, a third. I was very fine with that. Over time, of course, those numbers kind of shifted and changed as they got a little older. They felt the need to spend a little bit more and save a little less. But it was a good conversation to have with them about how to do that. Some families use jars or buckets, and you can physically put the money in each of those places. So that could be one possible way in which to sort of teach your kids about how to handle money. In today's world, if they're computer savvy and you want to sort of put together a spreadsheet that helps with that, or teach them how to do a spreadsheet on money, another creative way to sort of integrate the concept of share, save, spend with the tracking mechanism of a spreadsheet. On number 7, about the family mission, what we encourage there is to have sort of a guiding principle for why your family does certain things, why they sort of exist, what's important for a long-term focus. It could be as simple as being friendly to everybody. It could be reaching out to certain people or communities or other kinds of things. It could be any number of missions that you define and you decide together as a family. But having that sort of centering vision, we find, is a helpful tool. Kids are only with us for 15, 18, maybe 20 years. These days it could be longer than that, but so there's a limited amount of time with which to do this education and training. And I have to admit, my kids are now 27 and 31. There were days that I was not sure that what I was saying was actually being heard. But it was refreshing on a couple of occasions when I heard them parrot back to somebody else what I had said to them. So, they do listen, even though sometimes you think, not sure about that. So that's number 7, the family mission concept. Yes? Where did our microphone go? Here it is.
So I have a question about keeping up with the Joneses or the Kardashians,
Yes.
as the case may be. We try to talk a lot about, helping people and not necessarily having to have all the stuff that everybody else has. But that is a hard message to get across when other people have all the stuff.
Yes.
And so I'm curious, do you have any advice on, my kids know that I love them, but they know that I love them even more when they get the thing that they want, right? And so I'm curious if you have any thoughts on how to sort of balance this consumer culture that we live in.
Yeah.
Go ahead.
Yeah. It's a really hard concept and difficult to sort of stay on track with. It is hard because all their friends and neighbors and TV and whatever else, they're just bombarded with images. Phones, yeah. And any number of different outside influences that, we are now a part of. And, taking a break from some of these things can be helpful from time to time. What one of the lessons that I used with my kids was when they saw their friends with lots of stuff, was to say to my kids, all right, so what do you think their parents had to give up in order to get that thing for their kid? What did they trade? And it was an interesting thought process, an interesting conversation. And the other thing that I did, and this is a personal thing, so may not fit in your situation, but Jen and I were married 5 years before we had kids. And we did that on purpose so that we were more financially stable, so that we could do more things for our kids and not have to mortgage our future on providing all the stuff. And so we made that a point of conversation for them too, to say, we're able to do some of these things without having to trade or give up or have big credit card bills to provide these things for you. And the other point I'll make there is, some of the stuff that we provide or that kids get wear out fairly quickly. I mean, it doesn't last very long. And so when you have an opportunity to sort of have a reminder conversation with them, to say, hey, what happened to that pink scooter, or whatever the latest thing was, how long did it last? Was that a good value for the money that was dedicated to that? I mean, those are good sort of life lessons and good conversations to have. But it's really hard to sort of go against what all of their friends and neighbors and kids in the neighborhood have. So it's an ongoing challenge. But conversation is good about these things. Number 4, give yourself a retirement raise. So, this speaks to those of us that have retirement accounts available through our employer. Some employers have now begun with auto enrollment for retirement, 401k, 403b kinds of savings plans, where when you start, you're automatically enrolled at 3%, just a given. And, if you say, don't want to do that, you can back out of that. But it takes away one of those decisions that sometimes doesn't happen right away, which is good, because getting started early is really helpful. On the topic of the retirement raise, when you have an increase in salary, take a portion of that increase and put that into retirement. So if, for instance, you get a 2% raise, maybe keep 1% for yourself and put the other 1% into retirement. So instead of 3% contribution to retirement, now it's 4%. And the next year, maybe you go to 5%, and the next year 6%. And you just keep ratcheting up over time. What I have found in the 26 years I've been doing this work is that when families have the wherewithal to consistently do 10 to 15% into retirement, retirement looks pretty good. It just happens. When you're in that 3, 4, 5% range, it's a little bit of a challenge if you never get yourself into that 10 to 15% range area. So if you can get yourself there faster, that's always better. In the retirement game, more is better because it gives you options and choices. So you may or may not want to work till 65 or 67 or 72. You may want to retire at 55. And if you've had the consistency and the discipline to give yourself that retirement raise and build retirement early, then you're going to have those kinds of options and choices available. So help yourself when you have new money showing up. peel off part of it, send it to retirement.
And that would be across different retirement plans, Roth versus.
Yes. So the question was across differing plans, so Roth versus traditional. That's another whole conversation, but let me just touch on it briefly. So traditional IRA, traditional 401k plans, you're putting the money in before any tax is charged. It grows tax deferred, and then when you take it out, you pay the tax on it. With the Roth version of those plans, you are paying the tax before you make the investment. It grows tax-free, comes out tax-free. For those of us that are younger, the Roth makes all kinds of sense. For those of us that are older, that decision is a little harder. If you believe that taxes in the future will be higher than they are today, then it does make sense to pay the tax now at a relatively lower tax rate or tax bracket than what you would in retirement. The theory behind traditional IRAs has been that when we retire, instead of being in this tax bracket, our income will drop and we'll be in a lower tax bracket. So when we pull that money out of the traditional plans in a lower tax bracket, we'll get taxed less on that. Well, tax policy has changed and income brackets have changed and they will continue to change, and it makes it really difficult to know for sure whether that theory will continue to prove true. And you know, if you want most of your retirement money to end up going to your family, then the Roth makes better sense because tax is paid. If you say, I want to benefit charity when I pass on, then having traditional money makes more sense because charity can receive IRA dollars, 401k dollars, without having to pay the tax at all. So there's no reason to pay the tax if it's going to go to charity. So it's a complicated sort of conundrum of trying to figure it out. Any retirement savings beats none.
But that 10 to 15 range, you're saying between any combination of Roth?
Yes, any combination works. Yeah. Yep. Yes.
I was wondering, at this point in time, assets that are being handed off after the person dies, at what rate of taxation and exemption is in place now? I know it can change, of course.
Yes. Yeah, so it's an excellent question that comes with an answer that's a little wishy-washy, and the answer is it depends on a number of different things. It depends on what form those assets are coming to the individual. So if they're coming in the form of a retirement account, then the traditional or Roth label that's on that account will determine how the taxation occurs. If they're coming in a non-tax qualified label, so an individual account or something that's not an IRA, then in today's tax world, there's still a step up in basis. So if you bought the asset for this amount and it's now worth this amount, at your death, the value steps up to the current market value, and the person who receives it can sell that asset and not have a tax issue. There's some question about whether that step up in basis will survive some tax law changes that are coming. Don't know that for sure. Yeah.
But they wouldn't be paying taxes on the adjusted basis, right? You're saying that margin they're getting tax-free, but if they sold it, they'd still have to pay taxes on.
There would be the tax that would be due would be on the new basis after they receive it.
Okay.
So if it steps up and wipes out that gain amount, then there probably would not be any tax that would be due at that point. this is where it's important for me to disclose I am not a tax advisor. I am a certified financial planner, which, I know most of the tax code, but I would encourage a conversation with your tax advisor because they know your tax situation better than what I will.
So sorry, I didn't understand exactly what you were saying there. So if I have a house that I want to give to my kid,
Yes.
what happens there with the taxes?
Yeah, so houses, if it's your primary residence,
If
have
it's
a
not.
have a different sort of setting. If it's not your private or your primary residence and an investment property, then it would have that step up in basis concept that would apply to it.
So as soon as they inherit it, they would have to pay a tax, or if they sell it?
If
then
they
would-
sell it, they would not have a tax, but the step up in basis would just bring the basis up to the current market value. They could keep the property, and then if it continues to grow over time and they sell it down the road, then they would pay capital gains tax on the growth that's happened from the time they received it.
Got it. Okay.
So there's an advantage whether or not they sell it. They don't have to sell it to take advantage of that tax benefit. On your primary residence, if you're married, you can avoid up to $500,000 of capital gain on your primary residence. If you're a single person, you can avoid up to $250,000 of capital gain on that. So tax code is not the most simplified thing in the world, and it does depend a lot on your situation.
Okay, another one.
Nikki.
This is very personal, but I'm going to try and make it more general.
Sure.
We have a couple of kids in elementary school who are needing to go to a private school to get
Yes.
the kinds of support they need.
Yes.
What sort of advice or thoughts do you have as far as paying for elementary, sub-college level tuition that's not for public school, and also any tips on FAFSA?
Yeah. So let's take the last one first. FAFSA, the free application for financial student assistance, is a government form that becomes a sort of a document that determines how much financial aid an individual qualifies for. It depends on the family's income, depends on the assets they have, and sort of how that all works together. One of the huge benefits on getting more financial aid or lowering the amount of family contribution is to do savings for education in the form of a 529 program. So 529 is a code section of the Internal Revenue Code that allows states to do financial savings programs for the benefit of primarily college, but there can be some advantages to secondary schools also. And with the 529, money goes into that account, it gets invested, it goes in most states you get an income tax deduction at the state income tax level for funding that account, so it reduces your state income tax for funding it. The money grows income tax free and comes out income tax free if it's used for educational purposes. Fabulous program. And on the FAFSA, any asset that's in a 529 counts at 1/6 the value of any other asset. So it's a huge advantage when you know you're going to have educational expenses to be able to do the 529 program on the front end of that, let it grow tax-free, let it come out tax-free, and have it count less on the FAFSA. So the sort of the downside of the 529 is that if you overfund it, meaning you put more money in than you're eventually going to be able to utilize, then there's a penalty for pulling that money out to use it for something else. But the 529 has a broad ability to redefine, reassign that money to other family members so that you can sort of divert it still for education, even back to yourself to go get an advanced degree if you want to. So there is a lot of flexibility there, but the 529 far and away is, in my opinion, the best option for any kind of educational funding. And there are some situations where it works for private school tuition also.
On the 529,
Yes.
we've been putting money away for college for our kids, and there used to be a 15,000 a year limit, and I think it has been increased, but it's not clear to me now if it's 17 or if it's at the federal level or the state level. Do you know that?
Yeah, so the level that you can put into the 529 is determined by the state and by their program. Many of them have gone away from a per year number to a total number. And so for many of those, it's a like $255,000 cap that you can put in. The $15,000 that you're thinking of may actually be a gift tax number, so something different than the educational piece of that. But I think state of Colorado, if I'm remembering correctly, is at $255,000 total. You can do it all in one lump sum, or you can do it over time, or you can do it, some here, some there, some here. Just can't go over that 255 number. There we go.
One thing I noticed about one of those funds, and it seemed like there was quite a difference in fees depending on if you went and bought it through your bank or through like Vanguard or something like that. I was kind of shocked at what a bank could take off of that fund.
So if you're thinking about 529 funds, the state defines and sort of allows those numbers to be what they are. So the state controls how much each of those different investment options can charge. Some states do have the low-cost Fidelity, Vanguard kinds of programs as a part of their structure. Some don't. At the end of the day, the thing to be aware of in terms of fees and costs versus performance is how do those settle out. So some low-cost options, Fidelity and Vanguard, can be really good if you are comfortable making your own investment choices and sort of managing that portfolio. Some of us are not comfortable doing that, and paying an advisor to help with that makes sense. So I'm not here to say one's right and one's wrong. It's just two different options that are available. Most of the states that offer 529s have negotiated those fees so that you're not paying as much as you might pay on your own, because the state goes to Fidelity, Vanguard, whoever, and says, time out, we're going to bring you a big block of business. We want a concession. We want a break. And so they're able to kind of pull those fees down because of that.
This is more a question about, the ethics of how we use our money individually. We live in a housing market where $500,000 doesn't get much.
Yes.
And if we're lucky enough to already be an owner, upgrading, purchasing something more, we're getting into a lot of dollars that doesn't feel quite right when there's so much need out there. And so I know Everence is kind of in that business of helping us think about ethically, how do we use our money? But
Right.
It's interesting that you're expanding into Portland and Seattle and other cities that have similar housing markets, that it's a roadblock to think about the kind of money that would be going into housing upgrades or which is part of the, normal process for families to move through houses. But with this kind of housing market, how does one justify that kind of money?
Yeah, it's an interesting and troubling question all at the same time. And there's no easy answer there. Their equity within economic systems is a challenging topic because we, Everence, can have thoughts, ideas, concepts, but we can't control all of the variables that lead to housing inflation. And you know, the draw of these communities has caused some of that housing inflation to occur. Supply demand has caused some of that to occur. One of the things that we try to do, not to fix it, but to address it, is through the investment programs that we offer, trying to focus on helping underprivileged, underserved communities and markets do housing and do it in ways that includes everybody. And it's a small way that we can help, but it is a way. So if you own the Praxis mutual funds, a part of the program with Praxis includes taking about 1% of our portfolio and doing lending to communities that are underserved, and housing gets a fair amount of that, just as a way to kind of help bring things along. Those loans are at under market prices, again, as a way of trying to help get more equity within those markets. But it's a challenge, and there's just not an easy answer for how to do that. And yeah, if we're lucky enough to have bought in at the right time and rode the wave up, feel really good about that. But if you need to make a shift or a change, ooh, painful. And, you know, somebody like Jose coming into the Denver market, and yeah, it's just rough. You know, he's just starting out. He's a great guy, but he's not at the top of the pay scale, and won't be for a while because he's just starting. And rents are high and housing prices are high. It's just, there's no easy answer there. I'll say it this way. I have not come up with the easy answer. Maybe you have the answer, but we do what we can, but you know, and I mean, in some ways I'm encouraged when I see a lot of housing being built in the Denver metro area, because I think that will help with the supply part of that equation. But it takes time for that to happen. And, you know, Denver's a pretty okay place to live. And yeah, it's very attractive, and that is drawing lots of people. The interesting sort of post-pandemic piece of this that I don't think we know the answer to yet is for people who used to work in an office that now work from home, how will that shift housing values, and how will that change housing setups and all of that? I don't know the answer to that.
I think you're losing your audience.
We are, and we're up against our 12 o'clock time frame here. So thank you for coming. Thank you for your great questions.
Thank you, Dennis, for coming. We appreciate it.
We're available today, tomorrow, next week, whenever. So you can find us through Mary Lou, who is our advocate in your congregation here. But you can also find us on the everence.com website. So thank you all.
Thank you, Dennis.